This is Dr. V. Srinivasarao, lecturer in Commerce and Management in the College of PB Siddhartha College of Arts and Science. Now I want to share the information regarding the capital budgeting. Okay, what is the meaning of the capital budget? Capital budgeting is a technique which maybe we have to plan to invest, whether we have it is a practice or method, whatever it may be, whether we have to invest in a project or not. That should be decided by using this capital budgeting. Capital budgeting in corporate finance is the planning process used to determine whether an organization's long-term capital investments, such as the new machinery, replacement of the machinery, new plants, new products, and research and development projects are worth the funding of the cash through the firm's capitalization structure. That means maybe the involvement of debt or equity or retained earnings. This is the capital structure. Capital budgeting is the process of allocating resources for major capital or investment or expenditures. An underlying goal consistent with the overall approach in corporate finance is to increase the value of the firm to the shareholders. That means increase the value of the firm and also the increase the wealth of the shareholder. This is also required. Okay, next, capital budgeting. Six methods of capital budgeting. That means techniques of the capital budgeting. Different capital budgeting methods include payback period, the accounting rate of return, net present value (NPV), the discounted cash flow, and the profitability index, internal rate of return method. These are the techniques and methods of the capital budgeting. The first one, and in the best and familiar method of the capital budgeting is the net present value. Net present value. What is the meaning of the payback period? At a glance, we will discuss the namely payback period. That means whatever the or how much will be the investment, that should be we have to get back the period. That is called as the payback period. Accounting rate of return. How much rate of return we are getting. Net present value. Whenever we invest in the past, what is the value of the present? Whenever the present value in the future value. The discounted cash flow. That means cash flow will be this profitability index. How much will be the index? That should the internal rate of return method. This is also very. We will discuss one by one these techniques. The first one, payback period. I already told that payback period means the time or period our investment may be returned back. Payback period is defined as the number of years required to recover to collect the original cash investment. That means the amount invested in the project, in the organizations, how much period or how much time it may take place to recover our investment. In the other words, it is the period of time. This is the period of time at the end of which a machine or facility or other investment produced sufficient net revenue to recover its investment costs is called as the payback period. That means in the how much time we have to get back our investment. That is called as the payback. Whenever, for example, whenever we purchase land, the main question is when the value of the building or value of land may become the doubled or Whenever we invested, we are doing the business by placing the 10 lakhs rupees of the amount. How much period it required to get the 10 lakh rupees investment in our hand? That is called as the payback period. The next one and second one is the accounting rate of ARR. Accounting rate of return is the average net income an asset is expected to generate a dividend. What is the meaning of the dividend? Dividend means the amount of the amount or which may be given to the shareholder in the form of the share of the profits. The making the investment for making the investment, the part of the profit may be distributed and divided in the form of the dividend. That means it is applicable in case of the company form of the organizations. Shareholder, debenture holder may get the interest. Shareholder may get the dividend. This average capital cost expressed as a annual percentage. The ARR, average rate of return, is a formula used to make capital budgeting technique or aggregate capital budgeting decisions. ARR is very, very important in the taking the amount of the investment, whether we have to invest it. When the ARR is very high, we have to invest. That is important here. The next technique of the very, very popular and familiar technique or method of the capital budgeting is the net present value or net present worth applies to a series of cash flows occurring at different times. The value of the currency, the value of the money may not be the same in the different times. The past, that means present value of money, future value of money, past year. Today's today's are the amount. Today's cash is much valued than the same amount in the future. Today's and past years currency or amount is very, very worthful, much valued than the future value of money. It tells that the net present value or net present worth applies to a series of cash flows occurring at different times. The present value of cash flow depends on the interval of the time between now and the cash flow. Now means present situation and the cash flows also. It also depends on the discount rates. That means net present value accounts for the time value of money. Time value of money means today's money is more valued than the future value of money. Why it may takes? Why? Because when our money is a bird in a hand is worth more than the two birds in a bush. That is we have to keep in mind. Net present value accounts for the time value of money. Time value means money has the time value. Today's 10,000 is more valued than the after the 10 years 10,000. Why? Because whenever we deposited in any bank, whenever we make any investment in any project, compulsory it will generate some income. Compulsory it provides an income. That is we have to keep. This is the very, very important technique and familiar technique out of the capital budget. The next technique is the discounted cash flows. The discounted cash flows, DCF analysis, is the finance method to value a security or project or company or asset using the time value of money. Discounted cash flow analysis is widely used in investment finance, real estate development, corporate financial management, and patent valuation. That means This analysis is a finance method valuation of the securities. That means we have to assess the value of the securities, value of the projects, value of the companies, and also the value of the assets, how much it is. That means it is a parallel and equivalent technique of the net present value. Discounted, the rate of the discounted will be given. And the discounted cash flow analysis is widely used in the financing of the investments, real estate development. That means today's money and the future value of money, corporate financial management, and patent. Why it is a patent? Valuation of the patent. Patent means no one can use this patent. That means we only the responsible for the development of these patents. The next one, next technique of the capital budgeting is the profitability index. What is the meaning of the index? Index means some direction regarding the profit. The profitability index is a measure of attractiveness of the project or investment. It is the attraction. That means index. Index means the direction which may shows. It is calculated by dividing the present value of future expected cash flows, present value and future expectation of the cash flows by the initial investment and also the amount in the project. Initial investment means now or very beginning or starting of the period. The profitability index attracts the investors to place and to make an investment in the project. It is very, very important. The profitability index is calculated dividing the present value of the future expected cash flows, that is cash inflows, by the time of the initial time making the investment and also the amount in the project. This is also very, very the index profitability. Any business persons, any business organizations, prime and foremost important objective is the to to earn the profits. Not only the earning of profits, but also maximization of the profits. This is also very important. Any firm's survival or existence only takes place on the profitability. That means the investment made in the project or in the business, that is called as the profitability. Very, very important. The next and also the important part of the capital budgeting technique is the internal rate of return. That means IRR. Here we have to remember IRR will may be denoted in the term by using the R and also the K. That means cost of capital. Cost of capital comprises cost of equity, cost of debt, cost of preferential capital, cost of retained earnings. Then R is greater than the K. That means internal rate of return. These are the it takes the three situations. R is greater than the K. Internal rate of return greater than the cost of capital. It is the firm name is the growth force. When the R less than the K, that means declining forms. Then R is equal to K, that is the equal forms, whatever normal forms. Internal rate of return is the method of calculating an investment's rate of return. Whenever we place an investment, how much will be the rate of return? The term internal refers to the fact that the calculation excludes the external factors. External factors are uncontrollable and also the controlled us, such as the risk-free rate inflation, the cost of capital, like cost of capital comprises cost of equity, cost of debt, cost of retained earnings, cost of preference capital, or financial risk. What is the meaning of the risk? Risk means fear of loss. The method may be applied either ex post or ex ante. This is the internal rate of return. It is very, very, very important. And these are the various techniques regarding the capital budgeting. Thank you. Sponsor?